Well, good morning, everyone, and thank you, Barbara, for the introduction. It certainly is good to be here. The Economist Insurance Summit has had a following for many years and always creates a good level of debate. Now, economics is a passion of mine, and I guess it was first kindled at a very early age, I think at about 14 years old. And I had a fabulous economics teacher. His name was Jack Murphy. Now, I remember Jack well for a number of reasons. One of the main ones being he had a remarkable resemblance to Papa Smurf. And he had a pure white beard, and he had circular glasses, and he was wise. And economically, I think Jack was like an Antipodean cross between, I don't know, Keynes and Herbert Stein, but he claimed that Milton Friedman was his all-time hero and quoted him continuously. Now, Jack had a favourite saying. He said that only two things in life are certain: economic cycles and death. And Jack's view was it was better to plan for the former and try and avoid the latter if at all possible. But, you know, unfortunately in the insurance industry, in our industry, there are many who do a good job of planning for the latter, namely mortality, and trying to avoid the former, economic cycles. And of course, you can't avoid either. Now, when we look to the future, which is what we're doing today, we do need to plan for both. And I'm going to take you through a few trends I see. The title of this conference is The Next Frontier, Adapting to Global Change. Now, that is quite an agenda for one day. And when I look at the future in my crystal ball, I must confess that it takes on all the characteristics of a kaleidoscope. And it can be difficult to see what that true picture is. So today I'm going to focus only on a few of the key global changes as I see them, and these changes that are impacting both our industry and the economies and countries in which we work. So we can look at all these trends, but how do we know if we're making the right decisions? How do we know if we get it right? And the answer is, of course, we do not know. We will only know our true success in our industry many years into the future in all the countries and societies in which we work. And the risks we take and the investments we make as an industry, they're all long-term, aren't they? And that's why in Aviva, one of the values we've brought in is about creating legacy. We want to create legacy. We want to make decisions today that we're as proud of in 20 years' time as we are today. And that's why I've entitled my remarks today, as Barbara said, Being a Good Ancestor. Now, in a conference about the next frontier, it's, I think, all too easy to get carried away with intellectual and effervescent debates about the future of technology and be dazzled by ephemera. But fundamentally, the biggest changes that are impacting you and I and our businesses, I believe, are more social and economic. And I believe there's 5 key trends that are impacting industries, in particular insurance, and I want to go through each of those. The first of these trends to me is the age of disruption. The age of disruption is here, and conversely, the age of complacency that we were in for quite a few years, that age is over. We are all the more, I'll give you some examples, we're all the more than aware of the relentless pace of technological change and the influence it's having on our industry. But it's not the technology per se, rather than the behaviours associated with it that I'm particularly interested in. It's the adoption of technology. And the adoption of technology by consumers is still going at pace, we all know that. Some of you may know the stat. It took 360 days for Apple to sell the first 1 million iPods 12 years ago. It took precisely 1 day to sell 1 million iPhone 4S's in 2011. Smartphones, by our research, are set to connect an additional 3 billion of the world's citizens by 2020. And obviously the implications of that is our customers will deal with us all very differently. New agile competitors will act fast to disrupt the industries by meeting those needs. And one thing is for certain, that those new agile competitors, I doubt any of them or few of them will be sitting in this room with us today. The second of the 5 trends is geographic. I call this one shifting wealth particularly to developing economies. So here we are in this beautiful Dorchester Hotel in London, the centre of the world, GMT in fact. So let's look a little bit east to Norwich, where Aviva, by the way, was founded 318 years ago. Norwich with a population today of 375,501. And then let's look east of Norwich. In fact, if you look maybe a long, long way east, 240 million people in Indonesia, 67 million people in Thailand, 28 million people in Malaysia, 5 million people in Singapore, 90 million people in Vietnam, 98 million people in the Philippines, 1.2 billion people in India, and of course the most populous nation on earth, China, with 1.3 billion people and counting. And then we look to other points of the compass. What about the exciting countries that don't get as much airtime as Asia? What about Mexico with a population of 118 million people? What about Poland with 38 million people? What about Turkey with 76 million people? You know, the emerging markets in the year 2000 accounted for only 1/3 of global GDP. Last year, this had reached close to 1/2. By 2020, it's expected to have been close to 2/3 of global GDP. That's quite a trajectory. By the year 2030, the Chinese economy should have comfortably overtaken the US as the world's largest, despite fracking. And of course, this represents a growth opportunity for insurance. That much is clear to all of us. But I think, as Barbara said in her introductory remarks, there is much we can learn from these economies. Let's face it, Europe didn't invent writing, we didn't invent clocks, we didn't invent that quintessentially English beverage, tea. You know, the West, in my view, has still really not even embraced Asia, despite all these things. And the West, in my view, has not embraced emerging economies. For example, there are many in Europe and there are many in the UK who still refer to Asia rather patronisingly as the Far East. You know, to people sitting in Asia, Asia isn't that far. And I don't see Asia referring to us as the Wild West, at least not openly. And so I would prefer we use the term Asia rather than the Far East. But you know, growth won't just come from these exciting Asian markets. If you take Turkey, for example, Turkey's a young, dynamic country where 1 in 4 people is below the age of 14. Now, that's the same fact as the case with Southeast Asia was in 1998. Turkey is a country with one of the most connected young populations in the world. They have 9 million Twitter users, so maybe they'll be tuning into us today. And 42% of their population is on Facebook. That is, as far as I'm aware, the highest percentage of any population that's on Facebook. They have very low insurance penetration, and I believe that's a market with a great opportunity, and it's a market where Aviva is coincidentally a leader. But we also, all of us, can grow in the more so-called mature or established markets, whether it be in the UK or Europe. And we can do that by being innovative. We can do that by product packaging. We can do that by digital technologies. We can do that by taking ideas from other parts of the world, such as Asia. And we can do that in particular, in my view, by using data much more effectively. Which brings me to the third and probably most fundamental trend, which I believe is winning through data. Now, the use of data in insurance, of course, is nothing new. John Graunt used data in 1662. I believe it was 1662, when he constructed the first very early version of life mortality tables. But what is new is the avalanche of data in terms of volume and velocity, the rate of increase. Data, in my view, is the new asset class. 90% of online world data has been created in the last 2 years alone. And by 2015, with nearly 3 billion people online, data created and shared, it will be pushed to nearly 8 zettabytes. And for those of you with an interest in things mathematical, that is an 8 with 21 zeros after it bytes, meaning that the world IP traffic will quadruple by next year. It's an extraordinary figure, 8 zettabytes. By 2020, the quantity of stored data will be 50 times greater than it was in 2010. And we, my friends and friendly competitors, are a data-driven industry. Good use of data, in my view, is absolutely good for customers. Customers can expect better underwriting, more personalized quotes, and faster claims handling if we do it right. Data is and has always been the fuel in the tank of insurance. But like petrol, as an industry, we must use it responsibly and we must manage it securely. How much data is too much? I don't know. Customers, one thing I am sure of is customers need to trust that we will use their data wisely and responsibly. However, that trust is being tested, particularly in the UK, by excessive claims farming and using personal accident data, sometimes obtained illegally. This data is being used to harass customers, particularly in the UK, and this must stop. Some claims management companies do a good job for their customers, but the fact is there is a large number that do not. Claims management companies that are found to be buying or using data that is obtained illegally, stolen, should be criminally prosecuted. And I hope that the regulators in Europe, the regulators in the UK and governments decide to intervene appropriately. There is also no doubt in my mind that some aggressive claims farmers are encouraging fraudulent claims. And in an industry, an insurance industry, in our industry, let's call fraud what it is. It isn't leakage. It isn't claims inflation. It isn't exaggeration. It is fraud or theft. Fraud is not a victimless crime. It is adding to the cost of the law-abiding consumer's insurance, and in my view, that is unacceptable. So far, we've covered the age of disruption, we've covered shifting wealth to developing economies, and we've covered data. The fourth trend is what I've called older and healthier. And of course, this is a well-documented trend, isn't it? We will see the emergence of a generation aged 50 plus who will live longer and wealthier and healthier than ever before. The proportion of the world's population that is aged 50 plus is set to increase from 21% in 2010 to about 33% in 2050. We all know these stats. What isn't as well known is that China's 60 plus population stands at over 167 million and is predicted to more than double to 437 million people by 2050. And I think the real question for China economically, and therefore the rest of us and the rest of the world, is will China get old before it gets wealthy? But what about the UK? With the pressure on to reduce fiscal deficits, the funding gap, particularly for old age, will need to be filled. And us as insurance companies and people associated with that industry are well placed to help fill that gap when it comes to old age. When it comes to infrastructure, I know infrastructure was discussed here at length last year. Now, who better to fund infrastructure than long-term savings and pension companies. This is another thing that I believe helps us be a good ancestor. But with this long-term and commitment and benefit of insurance to economies and societies, obviously comes a contract with governments and regulators. This is clearly a two-way contract. Governments and regulators need to play their part to create the right environment to encourage industries like ours. For example, the removal of the uncertainty around Solvency II allowed the industry here to commit to the infrastructure investment in the government's Insurance Growth Action Plan recently here in the UK. I applaud this. Governments need to be brave, they need to be long-term, and like us, they need to leave a legacy. They too need to be good ancestors. And I accept it's not easy when the electoral time horizon is so short. And to support our long-term role in industry, this needs regulatory stability and regulatory certainty, and for many years we have not had this. And as an industry, we cannot build on shifting sands. That is not possible. Which brings me to my fifth and last trend, regulation. To be clear, I'm a very strong supporter of strong, prudent, conservative regulation. However, we have a regulatory tsunami coming at us. In Aviva's case, just in Europe, we are now dealing with 17 different regulators across our 7 EU markets, of which 5 are new since the crisis in 2008. We have a situation where no country wants to give up sovereignty, and Europe's approach to regulation is fine in the good times, but in crisis it is clear that nationalism still prevails. In Europe, I believe we need more clarity over who has sovereignty on each issue. In 2008, we also had 3 capital standards here in our business. And if some have their way, we could have 6 by 2019, all trying to solve similar problems. I think that's a problem. Now, I should say, though, I am supportive of the agreements and the direction of Solvency II. And as a business, we've been on economic capital for quite some time. And so I guess Solvency II isn't such a big change in mindset for us. However, we need to ensure total consistency with what's been said in Solvency II. We need to ensure total consistency when we get to the detail of the Level 2 text. In addition, we need to guard against gold plating, as gold plating measures only increase the cost to the consumers in the countries that want to do that. Now, of course, we need regulation to protect consumers, societies, economies. Sometimes we need regulation to protect ourselves. But despite what some would have you believe, I don't believe there's anyone in the insurance industry or in this room who remotely resembles Leonardo DiCaprio in The Wolf of Wall Street. Our industry, with a few isolated examples, did not suffer the same pain and meltdown as many of the banks. And finally, on regulation, I think we need to ensure total transparency of regulation in all our markets. After all, historically, regulation in some jurisdictions has been about as transparent as a Bitcoin algorithm, which, as we know, isn't so. So to conclude, I come back to my opening remarks that in a rapidly changing and fiercely competitive market in which we operate, it is those companies who stay true to the purpose of insurance who will be successful. There are many trends and changes, and many of those we will discuss today, and we have some very learned speakers later who will discuss, I'm sure, many of these trends in much more depth. But one thing hasn't changed. The success of this industry is all about looking after our customers when we need them most. It's about looking after them when we have the flood events like we've had in recent times in the UK. It's about looking after them in life-changing events. Fundamentally, that's what our business is about. But the truth is that many of the decisions that we make in our industry, whether it's pricing, whether it's products, whether it's investments we make, whether it's the businesses we support, the success in many instances is only determined over the years and decades. Success is determined by the legacy we leave as a business and the impact on the societies and the stakeholders and the shareholders, of course. It's not determined by the emotions generated by very clever advertising. But whatever the challenges that our topic for today, the next frontier, holds, we can be sure that the decisions that we make and the things we're discussing today will echo long into the future. As an industry, we need to leave a legacy. Ladies and gentlemen, I believe we need to be good ancestors. So I hope you find this day engaging and insightful, and I thank you.
Thank you very much, Mark. You gave us a stupendous introduction to the day, covering the main themes and challenges. I have a bad habit of always taking the chairman's prerogative and asking the first question, just in case it gives everybody else the time to prepare. You talked about long-term thinking on the part of insurance companies, the need for long-term thinking in government. You didn't mention investors. How do you convince investors, or what do you think investors' time horizons are these days? How much time do they give you to demonstrate your long-term results?
You know, it's an interesting question, and we are, of course, in results period at the moment, so it's a very topical question. Part of the issue that we have is the world is now filled with investors with short-term horizons, partly because of the emergence of data, and that creates in itself a systemic risk, as we all know. The problem we all have and the problem we all want is we all want the same investors. We all want the long-onlys. We all want investors that are going to be with us for long periods, and that's the same ones we target. I take the approach very much that I'm not worried about tomorrow's results. I mean, what I said in my remarks, at Aviva, we actually have a value set, a mantra. We say create legacy. That's similar to being a good ancestor. And if you take that as your fundamental guiding principle, you make the right decisions for the long term. And we also take that approach, and everyone's investment approach and the investment arms will be different. We take that approach in our investment field as well. We want to look at long duration. And we want to look at long duration, low vol as our key investment approach, and that's actually where we're focusing it. You know, we all, short-term investors, they'll come and they'll go out, they'll get burnt, some will make money. That's not a part of the market I focus on at all.
Good, good. Now, who would like to ask a question? If you do, could you raise your hand and a microphone will come your way.
Hi, good morning, Mark. Mark Sands here, journalist from Post magazine. I wanted to ask you, you talked about the importance of data and about the importance of trust in the insurance industry, people believing that they can trust insurers with their data. Obviously, this is something that Aviva have hit the headlines for in only the last fortnight, with reports of a couple of men who are Aviva employees arrested for taking data, I believe, from Aviva data banks, essentially. Do you not think the insurance industry itself, rather than looking at the CMCs, the insurance industry itself needs to sort of prove itself and prove that it can be trusted, and that leading companies like yourselves have a role to play rather than pointing the finger at outside bodies?
Yeah, Mark, thanks for the question. I think a lot of parties have to take responsibility. We have to look at ourselves, all of us. The security of data is, especially in the UK, is a major issue. And this is certainly an industry-wide issue. You know, the fact is, when you're getting people paid by claims farming companies a year's salary to give them data, people will be tempted. And to me, that's a major issue. And this is an issue across the entire industry. I think it is a major issue. We're not talking about sensitive data like financial data in the main. You're talking about accident data, but in my view, it's still entirely unacceptable. And in that situation, I think customers have a right to be absolutely angry on it. But the insurance industry cannot fix this issue by themselves. The fact is that unless we can take action against the people who are paying huge sums of money for people to steal data, unless we can criminally prosecute them, this will keep going on. Now, in terms of the people stealing the data, and what the case you refer, we are pushing very hard for prosecution. You know, we found it, we fixed it, but the issue is far bigger than those two people, and that's the issue that we want to address.
There's time for one more. If anybody else, there's a hand in the middle of the room.
Hello, it's Catherine Barton here from Ernst & Young. The points that you made very much resonated with me in terms of the 5 areas, but there's one I just wanted your further perspective on, which was around the fact that the biggest competitors in several years' time might be none of the insurers represented in this room. Do you think that the insurance industry is doing sufficient to protect itself from those other competitors?
Yeah, Catherine, I'm not sure we have to protect ourselves. I think we have to adapt ourselves, you know, taking the title of today. So I don't look at it as protection. Are we adapting enough as an industry? Absolutely not. Have we been as fleet of foot in things like digital as other industries? Absolutely not. Yeah, we spoke about data, but that's another area that I think we've probably been slower than some industries, despite the fact that we are a data-driven industry. Do we stick to our old models of distribution and products, particularly in mature markets? Yes, we do. I do think businesses in Asia are actually starting to adapt faster than we are. Now, that may be helped by the fact that, in general, Asia has lower regulatory controls and oversight or interference or whatever view you like to put on it. So that may help in innovation. But in our industry, I think we've been living on the past for too long. We have to adapt. So the clear answer to your question is no, I don't think we've done enough. But it's not about protecting ourselves. This industry is one of the oldest industries in the world. I mean, I think Lloyd's and Aviva are, outside the Bank of England, the 2 oldest companies in the UK of any sort. I think we're 318 years old, and I think Lloyd's is about 326, or give or take. Someone in the room maybe able to answer that question. So this industry has extraordinary longevity, and we've adapted before. I think in this round of change, I suggest we haven't adapted fast enough.
Well, Mark, I know we've taken an awful lot of your time, and you have a rather important company to run, but we really appreciate the time you've given us and your open answers to the questions. And please, everybody, join me in thanking Mark for his remarks.
Thank you.